Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgreen, the founding CEO of Lundgreen's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundgreen's Investor Insights. Join us as we dissect emerging global developments across central banks, financial markets, and economies globally. Welcome to the show and welcome back to Manila, Peter.
Oh, thank you. It's so good to be here, as always.
It's been 9 months since we did a video podcast, so this is our second, and a lot has happened in the global financial markets since then.
Yeah, 9 months is a long time in financial markets, and even for us with the podcasts, we have turned 1 year.
Yes.
Anniversary, so that's amazing as well. But yes, a lot has happened. A lot has happened in our own company. We are now growing again, and we are raising money as of offering equity. People can become shareholders in Lundgreen's Capital. So yes, a lot goes on.
For Lundgreen's Investor Insights, Peter, we've had quite a ride with our publications. So 5 magazines and counting for the year. So I'd like to invite our viewers, our audience, to check that out. It's available on our app and our website. So magazines and articles about the regions that we cover.
Yeah, we're doing a really good job.
Thank you, Peter. And it's, of course, we continue our monitoring of the global economy as everything unfolds. For this episode, Peter would like to look back at the megatrends that we identified last January and see how everything has fared after that. And also, we identify some wildcards, if we may call it that, surprises that we saw from the global markets over the past 10 months. And then, of course, as usual, we end with our global outlook, Peter.
Yeah, maybe also concerning the megatrends, as what we have been talking about, as you say, since the start of the year. It's also interesting to see if they continue into 2026, or will they change? So yeah, good topics.
Our first megatrend from a few months back was the global Trump effect. So we knew coming into 2025 that Donald Trump is returning as the US president. He had been vocal about cracking down on Chinese imports to the US, but it was only in the succeeding months when we saw just how huge the tariffs that he would impose on virtually every other country that they're trading with, and it's been quite a ride, and only very few trade deals have been set since January. And right now, there are back and forth discussions between Washington and Beijing, and it seems that they're not yet agreeing with each other. But the more interesting part of it, Peter, is as much as he wanted to target China, the backlash has largely been domestic.
If we do the sort of look back, that was our biggest worry, that he was simply, as a hurt economy, domestic US economy, and basically also global economy, as a simply destructive sort of an approach to what was going on, and it is also what we have seen. That the US economy is suffering. It is pointing further downwards when we talk about growth rates. Some segments are really under pressure. Lately, he's trying to resolve problems for the US farmers by simply handing out aid. Yeah. So this will pop up in the US economy more and more. This is what we expect also going into 2026. And another big and global trend that is the outcome of the tariff war is countries will simply seek new friends.
Yes.
So the trade routes will change. Very particular, investors should look into the Southeast Asian trade route, so to say. That is actually north-south, sort of China and typical what we would call ASEAN towards Latin America. That is obviously a Pacific connection there, and that is growing. So, is it a backlash to the U.S. economy? Yes, it is. And will other countries suffer? Some will, because it's a big economy, the American economy. But new trade friends will be invented.
Yeah, right.
So the world goes on, that's for sure, and also the show.
In the event that a new trade deal and lower tariffs are reached with Trump, it's even better for China because now you can resume your volumes shipped to the US. At the same time, you're able to increase the amounts you sell elsewhere. So, on balance, it's even better for China in the long term, I believe.
Absolutely, and it is remarkable to observe that almost as we speak, the Chinese government has just released sort of the 2035 targets,
Yes.
and that is to double the economy. And that means it is a very ambitious target. It needs to be replicated as a 5 to 6% in GDP growth per year, and it shows how much the leadership in China still believes in their own economy. It would be a disaster to do this forecast if the future growth would look like to be very flat. Then we will see even in China domestic troubles. So this is interesting, and the self-confidence is actually very strong among also the Chinese leadership. They simply see a world, including US, but not as dominant as before. And yeah, this is basically another sort of consequence of the Trump administration's policy. Yeah. So it's extremely interesting and very important for investors to follow.
Speaking of China, another megatrend that we mentioned way back is a manufacturing surplus emerging, and that has manifested in price wars in China, which in an era of interest rate setting is also challenging because now they're dealing with deflation at a prolonged period. It would be nice to initially to hear that, prices are lower than where they were last year, but in the long term, it's actually damaging when you look at it because consumers get the reprieve now because, they can save more, they can buy more with their money. But at the same time, if companies are unable to make profits or really to innovate, gain more by innovation, instead they're selling more because they're cheap, their goods are cheap. So it creates a problem as well.
But still, if we look into the development into the Chinese economy in particular, the efficiency is also increasing a lot, and that is due to the use of robots.
Yes.
And it is amazing that Trump is dreaming about reallocating a global low-skilled workforce back to the US to old-fashioned manufacturing lines that were seen in the 1930s. And at the same time, China is substituting the production lines with robots, and it just indicates that the pressure in the manufacturing sort of sector, the price pressure will continue. And this is it will be the most efficient countries and companies that will survive that one. And again, US is not in the lead, that's for sure. Looks and Wales. So and this mega trend that will continue also beyond 2026. It will go also the next 10 years.
Actually, speaking of efficiency, there is also that problem about a persisting problem about the middle income earners. Squeezed. I think they've been more squeezed in this year than in previous years.
When we're dealing with long-term trends, mega trends, so that can be sort of maybe for decades, and it is simply a long-standing forecast from our side that the middle income class in the old economies, the Western economies, and in the emerging market economies, the standard of living will simply get closer and closer to each other. And that is the key. And this is what we see. Also, we see a sort of a global leveling out on middle-income households, and where the pain is, that is of course in the Western households, because they will simply see that the earnings will not, the income will not go up.
Yes.
But there's a lot of families, a lot of households in emerging market economies. They're very happy.
You mentioned actually inflation is a smaller problem than it was last year, but in the US, it remains a pain point for the Fed. In Brazil, it remains an outlier because inflation has been rising, and it's keeping the central bank from cutting rates because, of course, the price pain is really still being very much felt by their citizens. So it is a tricky balance. In the US also, the job market is tightening, and it's also another point of consideration that's keeping I guess it's a double whammy for consumers, since it's harder to get a job or you're getting laid off. And at the same time, prices are much higher or rising much faster than where the government wants it to be.
Yeah, it's if we start again with the US, the inflation is what we call sticky, meaning it will not really come down to the level where a central bank is completely happy, but the view at the US central bank has flipped, meaning that the pressure on the labor market is
bigger,
more important than the sticky inflation, and the US central bank can actually easily live with inflation at 3 and 3.5%. It's not that bad, as long as I have a feeling it's not running too fast away. And then it is the lower US growth and the pressure on the labor market that is now getting the biggest attention. We should mention it is a sort of a slowdown in the economy. We are not forecasting a big recession, and by no means we are seeing any similarity to the global financial crisis in 2009. Actually, a lot of the households in the US that are a bit better off, sort of the middle incomes. So it is more sort of a growth challenge. So we are talking about things cooling off, but enough for the US Central Bank to cut rates, and that will continue. The cooling off will also continue. That's a sort of at least sometime into maybe mid next year. Yeah.
The pain point, as far as governments are concerned, is also supporting these squeezed consumers, and it's not exactly contributing to growth either. If you spend on benefits, social benefits too much, it's going to be piling up on your debt. If you're going to be spending on low quality or low level infrastructure, it's also not creating long-term growth, so to speak, and that's been the trend as far as the old economies are concerned. And also, the major megatrend that we've seen, and actually it has really panned out, is the tech-driven rally in global stocks. And it's been very strong, to the point where US stocks, for example, are now being called too expensive. And we have been saying that a correction is coming, and it's a lot of people, I think, concede to that observation as well. But really, the concern is, how deep will it go?
Yeah, that's always a question. The good question, if you are on the top of a correction, is it just a correction, or has the market really turned down and you go into a so-called bear market? We have the past 2-3 weeks sort of shared with our listeners, and today is also the viewers.
Yes.
That's an issue that is climbing on our whiteboard. That is sort of what we call financial market fatigue. Sort of all asset classes has gone up in price since basically October 2022. We sort of got very convinced in early November 2022 that this was a change in the market sentiment, and we sort of recommended to go overweight all kind of risk, just more in the market. And it has been a very long journey, 3 years, for a pretty positive market, yeah. And but not a wild one. So there have been time to absorb the trend. So no major correction has been needed, sort of to get a break, so to say. But now we simply see that prices on all assets are what we would call high. As we are, of course, talking about the tech stocks, the AI. Even the IMF is out warning on AI prices. Very, very impressive that they go down to this kind of investment advisory on such a detailed level. But also areas within the credit bond market, in particular corporate credit bonds, are simply now priced in a way. If we look at the spreads towards government bonds, it's so narrow that you could say that the corporate bonds cannot go further up unless we see a parallel shift in the interest rate level in the market. So it's sort of indications. How afraid are we? Not so afraid. What we argue is it's time to adjust the portfolios in a way so they are ready to a bit of sort of a roller coaster. In many portfolios, there will be segments that has gone out stock portfolios, particular tech stocks. They will all of a sudden have a much bigger size of the portfolio. It's good time to trim it. And maybe then we say, okay, time to shift a bit out of the corporate credit market. Are we seeing this market fatigue? Could it come down? Yes. Could we see a correction in general in the financial markets of 10 to 15, maybe more 15%? Yes, we could. Is it enough to jump out of the market, really go cash? Actually not. If it becomes 15%,
to catch it.
Then it is really difficult to sell on the top and get it on the as a low. More likely, if it succeeds, one might gain net 5% or something. It can actually be that the market continues up, and over time, of course, you need to be invested. So to find the right entry point again is, by experience, very difficult.
On the bright side, Peter, the second half of 2025 has been a much better time for public listings. Actually, data from PitchBook actually show that listing activity picked up in June to October, about 510 deals. In the first 6 months, it was 600. So quite a large catch-up for such a short span of time. We did say that 2025 will be the year when public listings, when IPOs come to life again after a quiet time since the past 3-4 years. And it's an exciting time.
It is. Should we be honest? We had sort of forecasted and hoped for even somewhat more higher activity on the IPO level. Again, a bit sort of the troubled water that was created by Trump's tariff war in Q1 led simply once more companies and private equity funds to simply wait for IPOs. Here in this region of the world, in particular in Hong Kong, the activity has been quite good, actually.
Yes.
But that is typical because Chinese companies that are seeking external listings, as outside mainland China, they have difficulties to be listed in New York.
Yes.
So the alternative is to do it in Hong Kong, and the dream is New York. But that is still a bit too difficult for many due to the relationship between US and China. Still, there have been a couple of milestones, IPOs in particular in this third quarter, where the company Klarna is one of the most prestigious, and that is the company where you can short-term lend to consumption. Short-term borrow, sorry. They short-term lend to you. Even I've seen a pizza you can have on financed.
First slice.
Yeah. Or maybe you pay back in slices. I don't know. But at least this is But it's been remarkable, and a lot of fintech interested investors are cheered by the IPO because it reveals some life in that sector. So there will be more to come, I actually believe.
Here at Lundgreen's Capital, we've spent over a decade building a strong track record with our full suite of services and high-performing funds. Now, we're setting our sights on something even bigger, an IPO in November 2027. It's been a long time coming, and we are ready for the journey. Join us in our next big step. Visit our website to learn more. As we look at these megatrends, we also found some black swan events, if you will, for the first 10 months of 2025. Events or developments we didn't really expect, but here they come. We can call them wildcards. And I guess the first wildcard has been, it's quite connected to what we discussed earlier, Peter. The squeeze for middle income, low to middle income earners has largely translated to civil unrest, higher living costs coupled with bad governance, lifestyle checks or seemingly inappropriate lifestyles. It's not just in Southeast Asia. We've seen some events in other regions, Africa also. In a way, there's quite a variant in France as well because they think they're being deprived and people have taken it to the streets to express their displeasure with how things are, how the economy is not working towards their favor. And it's emerging to be a trend, and it's likely to continue until such a time when maybe wages catch up convincingly or benefits are more provided in a bigger manner.
There's no doubt that, activism has gone up. And it's actually, it's pretty interesting. Should investors be afraid? Maybe, as I would say, if people are in the street because they're hungry, then it's dangerous for the governments.
Right.
Because there's
it's a different kind of anger.
Then people start to be really squeezed. But it's also interesting to see activism, as you mentioned, against bad governance. And now we are in the Philippines.
Yes.
And people here in the Philippines are truly fantastic, nice, and are quiet people. But anyway, right now, these days, we see, after all, big reactions on corruption. This is the unhappiness about corruption has, after all, met a new level. And interesting how it develops. So it can be that that the activism actually grows further in 2026, and some of it will lead to changes.
Positive, I hope.
Shouldn't be too afraid, but if it's because people are hungry, then that is much more dangerous.
Speaking of change, Peter, a lot has also changed as far as trade flows are concerned. We talked about that earlier, and the shift has been quite fast.
Yeah.
And including rebalancing of assets, of allocations, increasingly away from the US and elsewhere. We've always been of the view that where you should be is the developing Southeast Asia and even China, and we are seeing more and more interest. We're ahead of that view, and we're happy that we are. Yeah. But that's increasingly where we see flows moving.
And when we talk about structural, then we say this is not a speculative short-term move. It is actually money that has moved. New allocations out of US into the upcoming economies. Ratings are going up. Not everything is working as it should, but it is improving. Also, when we look into the new year.
And it's becoming trickier to invest in the US. Even the Fed is facing tougher times in their decision making. They've all but cut once this 2025, and the question remains as to when and how large the next move will be.
Also basically, the outlook could, we are just joining the probably 4 times 25 basis point cut, but it is already handed out to the market.
It's been a long time coming as far as the markets are concerned. They wanted it sooner than later, but of course, they know best as far as running the economy is concerned.
Yeah, but interesting, and it will come, and maybe you stabilize the market.
On to our global outlook, Peter. I think one of the major changes that we implemented as far as house view is concerned is really the change in allocation for the US from overweight to neutral. That was last April, after about 3 years as well of holding that view. We really switched it up because of really what's happening or how the US is faring with its tariff policy. And yeah, we've seen a lot of other asset managers take the same position.
Yeah, we have, and maybe it's also worth to mention that sort of the overweight US stocks that we reduced down to what we call neutral meant that we are increasingly recommending a non-listed investment into Europe. That's what you call private equity or venture capital. Is where we see still some upside. Also, if there should be some volatility, it would not really hurt this market. We are sort of recommending a change in the existing portfolio to what we still like to overweight risk, but now we call it well-considered risk. It's not just sort of the whole financial market.
Just on anything.
It's sort of a bit more well-considered. It of course makes things a bit more difficult, but despite the clouds and we talk about on the horizon, we are not afraid of them. We are not afraid of being invested and see still good opportunities.
As far as growth is concerned, it is kind of slowing down, largely because of global uncertainty and trade slowdowns, but there remains strong anchors of growth. And for developing economies, for example, that largely relies on domestic consumption. That's the trend we're seeing in Southeast Asia. Here in the Philippines, for example, China is also really focusing on local growth drivers, so to speak. And we see that performance in our award-winning China Fund, Peter, and that really is what is propelling global growth, despite some slowdown in the old economies. Increasingly, Asia is taking the lead, and that's been our view ever since.
It is, and it remains.
Yes. As far as the sunshine, it is here in our region, Peter, and we look forward to, of course, positive news about growth-supportive developments, not just here, but of course in the US and Europe as well. But increasingly, growth will be led by emerging Asia. That's what we have for today. Thank you, Peter. It's so nice to host you here in Manila again.
That's a pleasure. So good to be here.
Thanks for tuning in. We'll be on the lookout for market developments worth watching. Catch the next episode of Sound Economies, Mel and Peter on the Financial Markets, a podcast by Lundgreen's Investor Insights.